Welcome, everyone, to another exciting episode of the YouTube show and podcast, None of Our Businesses, where we talk about the week's news. It could be accounting, finance, tax, other kinds of business related, or it could be none of those things. But what it always is coming to you from the perspective of accountants. And with me today is Tammy Hess.
Hi, everyone.
I'm Ty Carr. And here's what we've got on deck for today. Is there a cure for employee burnout? Well, we've got one solution to look at here. The SEC has proposed new rules for private equity and hedge funds. Are they overreaching? Is it too much regulation? Or is it really protecting the public? And finally, the silver lining of the great resignation for audit firms. Can it improve audits? All right, well, I'm going to kick it over to Tammy to get us started here.
So last week we discussed how some of the big four firms were allowing for flexible holiday days, investing in work from home equipment, and increasing compensation in order to retain employees. This week, CNBC reported on how a company has implemented a 4-day work week to reduce employee burnout. How is that possible? Apparently, through employees rising to the occasion to increase efficiencies, trimming meetings, and blocking hours as meeting-free. They also did this without reducing compensation. The company has found that employees come back from their 3-day work or weekend refreshed, energized, and focused on work. Is this something that other companies are looking into? Well, according to the article, there's currently only a few US companies that have 4-day work weeks. However, there is an increased interest in moving in that direction. 35 companies are reported to start a trial of a 4-day work week this April. So Ty, do you see this gaining traction? And what are some of the challenges that companies may face in implementing a 4-day work week?
Yeah, I was just kind of thinking about what would the challenges be? How could it be implemented in an industry like ours? I think the primary challenge is that as a service provider, your competitive advantage is responsiveness and being available to clients. And so I think kind of my initial thought was, well, I could go to a 4-day work week if my clients happen to go to a 4-day work week, right? And on the flip side, it's like, well, I very much endorse my clients doing stuff like that, because even if I can't fully get to a 4-day work week, it's just the fact that they just shut down for another day would ease up sometimes for the workload that we have, right? But if I really put that to the test, I guess we do have some control, as service providers, we do have some control over how we contract, how we engage. We could potentially do something like that. We could potentially just say, those are the ground rules. We don't work Fridays, or we don't work Mondays, or whatever that looks like. I think what I do find though, is that having the team kind of all on the same page and the same kind of path works. So I think a different question would be, could you have some people who don't work Fridays and some people who don't work Mondays? Or could you have some people even that just take Wednesdays off, right? And, could you have 4-day work weeks where everyone's on a different 4-day schedule? And I think even that could be possible with some creative thinking, but my initial reaction, of course, starts with, oh, that would be harder, right? If the first level of getting a 4-day work week would be us all doing the same thing. If we all didn't work on a Friday or Monday, and that was, for example, a firm standard for us, that would be easy to communicate universally to clients, or easier to communicate universally to clients, and easier to coordinate with everyone, knowing that we just don't expect that people are working on whatever day that is that we chose. And having to remember or coordinate the different schedules of different people off or on different days could then get, I think that definitely adds extra challenge. Not impossible, but just extra challenge. Those are some thoughts I have about trying to do this. I think, I'd love to hear if I inspired any additional thoughts from you on that.
Yeah, I think one of the examples that they did say was that everyone else in the company worked Monday through Thursday, but the customer service side of things, which is probably more of a 24/7 or 5 days a week at least, or even could be 7 days, they did a kind of a structured one where they had rotating, people. So even though all the employees still worked a 4-day work week, it was what you were saying, like they kind of had Mondays off or Fridays off or somewhere. So there was always coverage. And I think that what you said is 100% true. This can be done, but it really are going to have to do some planning and some coordination. And then the other thing, really, in terms of client service, or if this is a service type of company to do it, is you have to think about how do you share responsibilities and increase communication so that from your customer's point of view, they're not seeing a lag in the fact that they have people not knowing, oh, I talked to, Betty Sue on Sunday, and no, the person I talked to on Monday has no idea what I talked about or what I'm doing. So they could get interrupted by their service. So I think that you're going to have to really be creative in that sense. And really it requires increased communication and planning. And then from a leadership perspective, it's going to be remembering who's doing what on what days and how do you implement it and stuff like that. But that's all achievable. But it is an interesting approach, I think, to help with that. I think the other thing I would probably say is this something employees want? And with any of these type of, strategies or methods, the all or nothing approach doesn't seem to be really the one thing that's working. It's usually being flexible across the board to really tap into what the employees' desires are, because they could be different. There might be folks who are like, I don't want to have a 3-day weekend because, for whatever reason, I personally can't think of one yet, but I'm sure there's some people who, would much prefer having a standard 2 days or like you said, want Wednesdays off instead and have a kind of a mid pause or a mini weekend in between. So I think it's being flexible with your employees and really asking them what is it that they want and what they need and what you're trying to address.
Yeah, as I think about my own personal lifestyle, I'm not sure a 3-day weekend works well for me either, because, this goes to that term kind of work-life integration, right? It's not, sometimes that one size fits all doesn't work well. And so an example for me is like, when I think about, well, what do I do with my time off, right? One thing that I think a lot of people would have in common, you may have a spouse or a group of friends that you hang out with, right? So that gets to this point of, well, if your company has a 4-day work week, but your friends or your family don't have 4-day work weeks, then, you might be kind of hard pressed to really figure out what to do with yourself that extra day, right? Particularly if the 4-day work week means that you're working more hours on those 4 days, and that takes you away from your family and friends on those 4 days when they otherwise have some extra time those days, right? And I think that gets to like that's the nature of my particular issue, which is like one of the main things I do with my time off is I like to garden a lot. But I also, as I've gotten older and my energy level, I can't actually garden like 6 to 8 hours a day. I can go do it for like maybe 2-3 hours and then I'm kind of pooped out. So as a practical matter, it's better for me to have more time throughout the week to garden than to just have one free day to just go all out on gardening. And so, if I had if I'm just looking at my gardening activity as what I'm balancing, I probably wouldn't choose a 4-day work week. I would say, well, I'd rather work less hours Monday through Friday than bunch them into Monday through Thursday so that I have gardening time every day, not just trying to stack it all up on a Friday kind of thing. So those are some additional considerations I think that make it, I think it is probably very individual. It's not universal that everybody would want complete days off rather than kind of spreading their time out off a little bit.
Yeah. So in that, because I totally agree with that. And I think it leads me to another question though, is do you think then it's practical or even reasonable to try to create overall flexibility on an individual basis for, to really help with employee retention? Or is it something that you have to do maybe moderately or have a couple of options, but could you really have 100 different options depending on what employees are looking for?
I think it depends on the industry and it depends on I think it depends on the industry and the nature of the jobs that people have. I think in our industry, and it depends on the size of your business too. I think, for our particular business, at TCA in our particular firm, we're fairly small. So we have, that has the advantage of being able to customize things for people to some extent. Right. And I think your ability to customize is naturally, it goes away at some point as you get bigger. But then there's also a different question in terms of like in a business like ours, it's how many layers of overhead do you have going on, right? Because if if you're in a service business where you've got a lot of high level people who are responsible to clients, then the limiting factor to flexibility is the clients, not the firm itself, right? And I think, I'd love to see that TCA stays that way, in the sense that it's never that TCA itself is getting in the way of our people in terms of their schedules and how things go, but that they're able to, that our people as professionals are able to kind of work out their schedules with their clients and their client loads, and that they're not that it's not that the firm's overhead is somehow causing them to then have to also work extra days or extra hours when they otherwise wouldn't have, because they already have a nice sweet schedule worked out with their clients. In other words, I'd like to think in a firm like ours, if our professionals can work out a pretty good schedule that works for them and works for their clients, that's the standard. That's what you're looking for. But in large organizations, it's not like that. It's like you know, particularly as you get up into leadership too, right? Because you got all kinds of meetings and people that you got to coordinate with. And so even though you may not have a client meeting that day, you may have a firm committee meeting of some sort that day. And that's where things start to kind of weigh on people. And so I think the trick is, I don't know, because we haven't scaled to a size where that becomes an issue, but it'd be interesting to know as we grow our own firm is as you scale, is it possible to keep those kinds of things in check? And I think that's part of what the article was talking about reducing meetings and things of that nature.
Yeah. Well, something to look forward to, something to keep an eye on. And I think that we'll see how the test pilot goes over the 35 companies that are going to be doing the 4-day work week. And I also think that what did inspire me about this article is thinking about meetings differently, because I do think that is meeting burnout can really, and not only impact efficiency of folks, but it also impacts people's kind of own morale. If they're jumping from meeting to meeting and not being able to focus on other things and are trying to work around that, it can be difficult. So something to keep on looking into, and I'm sure we'll discuss it more as we hear more. So Ty, you have our next article?
Yeah, I think the topic, which is actually, if you Google this topic right now, you would find it across the financial press. I found an article on it for a link that our viewers can look at from the Journal of Accountancy, but I also read about it on other magazines like the Wall Street Journal and the Washington Press, other newspapers, that is. And so what's happening is the SEC is proposing rules to require more disclosure and more accounting type disclosure as well from private equity and hedge funds. And so, private equity and hedge funds, these are private organizations that are not ostensibly public organizations, and they're not regulated at the same level that like a public company is regulated. But the SEC chairman, his whole point is that they have a huge impact on the economy, and they're big players in our economy these days. And so the SEC feels that they should have more disclosure requirements. Now, they're not actually, my understanding is their proposal does not include requiring public disclosures, but what they're trying to do is require more standardized or regulated disclosures that have to go to the private equity or hedge fund investors on a quarterly basis. And I think they're also including a financial statement audit requirement in there that isn't currently there. And so that could spell more work for the accounting industry, of course, in doing that. But the big debate, which I think the Journal of Accountancy article that I'm providing a link to, it didn't necessarily get into this issue in depth, but the big debate that you'll see across the rest of the financial press lies in this point, which is that conceptually, and some of the people, the fund advisors and managers in private equity hedge funds will be making this case, and their lobbyists for sure will be making this case to Congress, that the investors in private equity and hedge funds are sophisticated investors who have the resources and the wherewithal to make an evaluation of their own investment decisions, and they don't need government regulation coming in and requiring disclosure to them, kind of thing, right? That the government does not, from a regulatory standpoint, need to protect the public in that environment the way they do with a public company. And, even particularly today, with the advent of, we know this is kind of probably obvious to all of our listeners, with the advent of things like Robinhood and the various investment apps and everything, retail investing has become a thing to the everyday person, right? And so there's a social policy that there's got to be good disclosure and audits and things like that to protect the public. But the fund managers, that what they're going to be arguing, and what they are arguing, they're going to be arguing is that concept shouldn't apply here, because the investors in hedge funds and private equity are more sophisticated, they're more wealthy in general, and it's not a protecting the public kind of thing. So I thought I would kind of throw it back to you with that question. Is the SEC kind of getting too regulatory antsy here and worrying about a population that we don't need to worry about?
Yeah, so I'm going to answer the question with the question, which I know everyone loves, but I think that the kind of pushback I would say is, or my question is, why is there such pushback to go forward with this, in terms of why, other than the cost of maybe potentially having an audit, or maybe having people perform that, the information or reports going out to the investors, most of that stuff should already be being performed. So I'm not sure I understand why there's such a pushback not to disclose this information or provide this information to investors, whether or not it's deemed that they need to be protected or not.
Well, you said it. I think that is exactly what they're citing, is the administrative burden. And that's fair enough. For public companies, particularly large public companies, the administrative burden of having to produce SEC standardized financials and disclosures, along with the cost of the independent audit firm, is not insignificant, and so yeah, I think that is what they're hanging their hat on. Of course, what you're alluding to is also, or what your question might allude to, is also what the SEC is basically saying too, is that perhaps some of these fund managers are hiding things with, with the lack of disclosure, that the lack of disclosure is allowing fund managers to maybe have hidden fees, or not fully be transparent about the performance, on an interim basis of their funds and things of that nature.
Yeah, because that's where my mind is going to, is that I do believe that most accredited investors who are investing in these types of platforms should be either A, knowing the risk that's involved, B, asking for questions that they do want to have the information to, and obtaining those records of those reports if they deem that's appropriate. But at the same time, if they're not, and the poop hits the fan, they're kind of saying, how come I wasn't informed? How come I wasn't doing that? And I think in that way they do need to be protected, even though they should have all known better and they're accredited. I think where this comes into play is when something goes wrong, and then they're looking to the SEC, or they're looking to other people to saying, why is it? How did you allow this to happen? And it's like, well, you could have asked for that information, and it is on them. But yeah, so I don't think it's overreaching on the SEC side. I don't think it's going over to the details, but I also am a firm believer that people who are investing money into these types of funds should be asking for that information anyways, and it should be available anyways.
Yeah, and I think, and my 2 cents on it, on that front, is that, and this gets very deep philosophically, but I think that what a lot of times people miss is, when you talk about SEC disclosure as being public protection of the investor, I think what we miss from that discussion is the investor's play in capital allocation and the effect that it has on the economy. And I think that is in part what the SEC chairman was alluding to, inferring, when he talked about the fact that that hedge funds and private equity funds are making up a bigger chunk of our investment economy. Is that, even if you accept the argument that a high net worth investor should know enough to ask for the information they need and understand whether they're getting what they need, and if they don't, then who cares, right? They deserve to lose if they lose. Like, even if you take that position, what you're missing in that argument is that the action of allocating capital to the best and highest, most optimal projects is an economic function of our society, that society wins when capital is properly allocated in general. And I think a lot of people who listen to me say that are going to roll their eyes and plug their ears and say, well, that's very abstract and very philosophical, but that's what I've always believed about, and one of the things that I think is one of the pieces that, if you really think about the function of auditing and financial accounting and some of the things that we do in our industry that can be quite exciting, is not the fact that we simply can help rich people be better investors, but that when rich, high net worth, or institutions or anybody allocates capital properly, it's the entire economy and society that wins. But nobody, so everyone has a job in that economic function, right? And we think about it just ending at the investor, like it's like the investor wins or loses and it's all about them, right? Not really. It's like the investor's playing a role in the economy. They're allocating capital. And if they do it improperly, the economy doesn't do well and everybody suffers with a bad economy. So bad capital allocation is not just a matter of an investor losing their own money. It's also a matter of a stagnant, if it's rampant, if a nation like ours is rampantly allocating capital to the wrong things, then the economy in general won't do well. There won't be good jobs. And that's the economic theory that I bring to the table in thinking about this kind of thing.
So indirectly, they are protecting the public.
Yes.
So for the past few months, we've been discussing the Great Resignation, primarily from the perspective of why people are leaving or what companies are doing to retain employees. I found an article from Accounting Today that focuses on the impact it has had on auditing firms. They actually have to rethink on how to perform audits. So with the reduction of staff, the article recommends that the audit firms look into how to create capacity with their existing staff. And then as we discuss these, I think we might find that this could actually apply to other companies or service companies outside of audits, but we'll see. The article offered 5 recommendations that, if implemented, could lead to more efficient audits, and which in their view is the silver lining to the Great Resignation. So the 5 recommendations are: 1, stop blindly following Sally, same as last year. So as a former auditor, I have been preaching this concept for years. I still remember getting fired up when I would see the term SALY documented as a response to an audit procedure in the audit work papers. So this really got me going. But I did like how the article encouraged taking the time to study and understand the audit standards to fully understand what is really necessary, and incorporating the risk profile of the client and finding alternative ways to achieve the stated objectives. One of the key suggestions is to focus on the high risk areas first, or the hardest areas first, rather than saving them to the end of field work, which could often, you can find yourself not having enough time to actually complete it and then have to extend the field work time. So 2, hire for the required skill set. This stresses the fact that not every task in the audit requires a degreed accountant to perform the task. Therefore, the article suggests utilizing interns, bookkeepers, or other less experienced employees to perform the tedious and/or manual task. Now, I find this approach interesting because typically the routine or tedious tasks are assigned to a first-year auditor, as it's usually low risk and relatively straightforward. The audit senior or manager can quickly train the new auditor on this task and keep them busy during the audit. The downfall, of course, is that this is usually not the most efficient way of performing the task, and it can often give the new hire the impression that their job is boring and causing them to seek a more exciting job. 3, hold clients accountable to be ready on time. So this is pretty straightforward, providing clients with a list of documents or worksheets ahead of time and holding them accountable to have it ready at the start of the audit. If they're not ready, have them reschedule. 4, leverage technology sooner. So this can be done by investing in specific analytic software or by utilizing Excel to its fullest potential. The key point to this recommendation is taking the time to think of what tools that you can use to reduce the manual task that's done during the audit. The 5th one and the last one is shred the D and F clients. So this recommendation focuses on ranking your clients based on the quality from A to F and determine if they are ones that you should keep or not. Now, I would say that if you're heading into this busy season, and if a firm hasn't done this already, it's probably not the right time, because if you decide to eliminate an employee or a client, sorry, right now, it doesn't give them enough time to find an alternative firm, and they could get pretty upset with you. But I think the point of it is to really consider this on a regular basis. Have set a time, whether it's quarterly or annually or biannually, to review the clients and see if they are the right clients for your firm. And then really, I guess what I want to talk to you about, Ty, is, do you have any other recommendations that weren't included in this list? Or do you think that there's any that were included that are radical or a new concept or could be difficult to implement?
Yeah, I mean, I think, in terms of, are these radical or new concepts? I don't think so. I mean, I think, I think that if there wasn't a labor shortage, if there wasn't a great resignation, then professional service firms, if they're looking to improve profitability, are following the same, they're kind of looking at the same kind of recommendations, right? I mean, this is tried and true kind of recommendations and things that you hear in most circumstances about how to improve firm economics, because at the end of the day, it's about providing, meeting your client objectives. And if you can meet your client objectives with less people hours, then you are improving your efficiencies and usually your profitability in some fashion, right? So even without a great resignation, I think we've heard many of these things before as good good practices for improving efficiencies and profitabilities within your firms. But then what does the great resignation add to this? I think what it adds to it is almost an imperative, right? Because now it's not just a matter of, well, we need to reduce the number of people hours in order to be more profitable. It's a matter of, we literally don't have the people to do the hours. So how do we meet this how can we still meet the objective with having not enough people to meet these objectives, right? And so the driver, the great resignation provides a slightly different driver. It's not purely about just getting to better profitability, although doing this for the purpose of the great resignation will likely also lead these firms to better profitability as well. But they've got this different driver, right? The fact that there's just not enough talent available to do the work in the same way that it's done before. And so we're seeing kind of the same ideas kind of being put out there as, how are you going to do that? How are you going to do this work with less hours? And yeah, I mean, I think I don't feel like I take exception with any of the suggestions. They all kind of seemed reasonable to me. I guess, it was interesting, the first one, when you talk about the Sally issue and how, that may not be a great way to keep doing it. I mean, and I guess, what's very on the point about that is, if you're dealing with half your team has resigned and you're kind of replacing them, and you've got a new team, they really can't do Sally, right? Because they weren't the ones who did it last year. So I think that kind of turns the ability for firms to use that as a tool. It kind of turns that on its head. But yeah, the rest of it, I think, all sounds like good ideas. I mean, the devil's in the details. Whether you can actually do those things in practice and in real time is a whole nother question.
Mm-hmm. I would agree. And because I'm so obsessed with the whole Sally part, because it really was the thing that drives me nuts, I think that is something that is for other companies to think about, because how many times, in terms of whether it's an accounting team in a function, or it could be other teams as well, that they're like, well, this is how I've always done it, so this is the way I'm going to do it, for the foreseeable future. And it's like, people should, in theory, just think about, should it be done this way? Just because it was done this way for the last 5 years or 10 years? Is it the most efficient? Does it make sense to do it? There should be at least a conversation or a thought process to review any procedures or steps or the things that are being done. And I think we talked about this a couple episodes ago, but if you're always, providing a report and no one's looking at it, do you need to continue to do that report? I think that there's ways to really evaluate productivity, efficiency, the need for certain things on a regular basis, and not, I wish as a kind of a general practice to be a little bit more proactive than reactive, not to shred these things or think about these things because right now there's a problem in terms of staffing, but really think about plan for, trying to improve or be more efficient or strategize differently in a time where you have time and you're not doing it because again, the second time today, but when the poop hits a fan, you don't want to start implementing some of these things because it's too quick and you haven't thought through the whole process.
Yeah, change is always more expensive when you are under the gun having to do it at the last minute than if you have the time to think it through and kind of work it out over time.
And then the other thing I was thinking about too is to think about the staffing and needs that the client has, because not only, the firm is not the only, place that's dealing with, lower capacity or staffing challenges. They might find that at their client side as well. And so really talking to the client in advance to see what their needs are, what their time commitments can be, because it might have shifted if they don't have the team to be able to provide information or to be there to work with. So it's kind of there's issues on both ends of, being the service provider as well as being a client in that case. Thank you for joining us for another episode of None of Our Businesses, where we discuss news in business, accounting, and taxes from an accountant's perspective. Please hit the like and subscribe buttons if you are watching this on YouTube, or rate us on your podcast app. See you soon. Bye.
Bye, everyone.